Stock compensation can be a powerful wealth building tool, but only if you truly understand how it works. When you're busy managing your career, your family, and everything else, planning around your stock compensation is easy to shift to the back burner. In this video, I'll walk through how to approach your stock compensation with more intention. We'll cover what's in your control, how taxes come into play, and how to avoid the common pitfalls we see even among the most successful executives. Hi, I'm Emily Harper from Monument Wealth Management. I want to start by painting a picture. Imagine maybe 10 years from retirement. You've had a really successful career so far. You think you're doing all of the right things. You're maxing out your retirement accounts, you're building savings. You've accumulated a lot of wealth in your company's stock, from both stock options, maybe employee stock purchase plan. You're feeling pretty good about where you are and the likelihood that you can retire in 10 years successfully. And you're not necessarily doing anything wrong. But if you get to the point where you have a lot of your net worth tied up in your company's stock, where you have a lot of stock options that you've accumulated and you haven't exercised, you might be missing some opportunities to optimize from a tax standpoint and use it for some purpose in the short term versus continuing to accumulate, and grow. This is a scenario we often see. We work with people who are really proud of what they've built, and they should be. They should be proud of that success. But when you don't take action, there's some things that you may be leaving on the table. So let's dive into some things to think about when it comes to taking action. The first thing that's important to know and understand is just what you have and how it's taxed. There may be a lot of different components to your stock compensation. We often see restricted stock units, which you don't have a lot of control over, unfortunately. When you're given restricted stock, if you're employed when that stock vests and you meet whatever requirements are dictated in your agreement, your stock is going to vest, and that stock vesting is a taxable event. That stock, the value of it on the day that it vests, is taxed as ordinary income. So when we think about ordinary income, that's just like a salary or a bonus. It's taxed based on the rates that are attached to the tax brackets, unlike capital gains, which are taxed at a lower rate. So it's really just a form of kind of cashless compensation. Now, when those shares vest, you can just take the shares and let your wealth continue to build in your company stock, or when the shares vest, you can sell and create cash for investing elsewhere or using for some other purpose. You may also have options as part of your compensation package, either non-qualified stock options or incentive stock options. The big difference between those two is how they're taxed. But again, with options, you're not actually receiving any shares of stock unless you choose to exercise your options. And when you exercise your options, you're buying shares of your company stock at a given price, which ideally is lower than the price of where that stock is currently trading in the market. So you'll be taxed on some element of the difference between what you buy the stock at and what it's actually trading at. So again, that's another way to create some wealth from the value of your company stock. When you exercise your options, typically you're either coming out of pocket to buy those shares of stock because you want to hold on to those shares when you exercise them and let them continue to grow, or you're doing cashless exercise, which allows you to just receive the value of the shares, less the exercise costs. Now, in both cases, with restricted stock or stock options, if you choose to hold on to the stock, then you're going to have capital gains in the future when you actually sell those shares of stock. So you have the initial taxable event of either vesting or exercise, and then if you hold the stock and it grows, when you sell that in the future, then you have a capital gain. Now, what are some of the pitfalls we see around planning with stock compensation? If you don't understand what you have and how it's taxed, you might not be taking the right actions along the way when it comes to making sure that you're covered year to year from a tax standpoint. We often see, especially with restricted stock when that's vesting, not enough shares are sold to cover the taxes as withholding. Not knowing what you have, not knowing when it's vesting or what it's vesting at, and understanding how that's driving your overall income for the year can often lead to underpayment of taxes. If you don't have enough withheld and if you're not making estimated tax payments, you could be subject to a large surprising tax bill come April and maybe even some underpayment penalties and interest. So we definitely want to avoid that. Another pitfall we see is just not thinking long term. When you have a lot of different elements of stock-based compensation as part of your overall package, you probably have things layering on one another over time. You may be getting new grants of restricted stock every year in addition to the ones that are vesting. You may get new grants of stock options. If you're not being intentional about how these things are building on each other and understanding what that looks like, you're likely missing out on opportunities to take some action, not only to optimize for taxes, but also to create cash flow as needed from your awards as they're vesting, or to diversify. As these things build and layer, you're going to get a lot of concentration in your company, and that comes with risk in and of itself. So we always urge our clients to really be mindful about what every element of the package looks like and how those elements interact over time. Don't let the tax tail wag the dog. I've seen too many people wait until the last minute to exercise their stock options because they didn't want to take the tax hit. But by doing that, you may be kicking the tax can down the road and inadvertently creating a larger tax bill for yourself, or reducing the after-tax value of your options by not exercising some along the way. We see this all too often with clients who ultimately end up paying taxes maybe at that highest tax rate because they've just let things accumulate for fear of realizing taxes along the way and then end up with a bigger tax bill. That's a wrap for this video. But before you go, if you found this video helpful, hit subscribe so you don't miss any of our new videos. And join our newsletter for access to a private YouTube playlist with monthly insights from our investment team. Curious how your wealth strategy stacks up? Schedule your complimentary wealth check on our website. Links are in the description below. I'm Emily Harper, here to help you make life option rich. See you in the next video.